Hello everyone, this is Juan Sarmiento and today is Friday, July the 14th. As you can see, my account here on the cover calls have been doing pretty well. And so with just a couple of months and with only $150,000, we have gotten about 10% of return. So let's look first at the account, the IRA account. I created two simultaneous accounts. One is an IRA and the other is a margin account, so we can trade them simultaneously and see what the difference is, you know, with their advantages and disadvantages. So let's discuss that. You can see here that I have my trades. They're pushing back a little today, but what I'm going to do is going to go through, let's organize them alphabetically and go and look for each one of them and see what needs to be done. Today is an expiration day, so yeah, we need to look at that. All right, so we started with 100,000 and now the net liquid value is $107,738. So we have nice little profit here, almost 8% in just a couple of weeks. Yeah, not a couple, but say a month or two. So let's examine the trades. Starting with its APA, we can look at the chart, see where we are in terms of volatility and stock price and so on. It's pulling back a little bit today, but it's been doing pretty well. The volatility remains pretty high here. So let's go to the Analyze tab and see what we have. All right, so this is the original trade, but you can just show the actual position here. All right, and you can see that this option is expiring today, and the stock is trading a little higher. And if I were to close this, I need to make sure that I'm paying 0 in extrinsic value. Okay, so let's add simulated trades and go to the stock that I have here. Is the options that I have -3 here, and it says 3 cents of extrinsic value, 1. Okay, so if I wait until the end of the day, this will be 0. Okay, but I would like to roll it over. Yeah, it's 1 now. Okay, so I want to roll it over. How do I roll it over? Well, I need to buy this back. Okay, if I don't buy it back, because it's an option with intrinsic value, that means that if I let it go, it will be assigned and my stock will be taken away. Not that that means anything. It just means that in order to keep it going, it's without having to buy the stock again, we can simply roll over. What do I roll over to? Well, the next option that has 28, 35 days to expiration. Okay, let's say the 28. All right, I look for the option that is closest without any intrinsic value. 37 sounds good. Okay, that's the closest, and the extrinsic value is 1.6. So I'm going to click here on the bid, and I'm going to say 3, and I might want to look at the option itself. And how much value am I getting? 492. Okay, that's very close to 500. I'm with that. Okay, happy with that. We're looking for 500 maximum value, because the options that I'm selling, 164. Okay, if you get the calculator here, 1.64, okay, times 100, that's the value per option. Okay, that's the extrinsic value that I'm getting, because there's no intrinsic value in this share. So I will get 164 times 3. So I'm getting $492. And I said to you that if I get something like $500, I'm happy with that. Get it? Okay, so I'm happy with rolling it over to this particular option. So I select this call and I say analyze rolling. And I'm gonna close the July 14th, but I'm gonna open the August 11th, and my strike price is 37. Okay, so I delete this one here, so I know, oh, look at this. Well, I need to select my current trade, and this is the option that you can say expiration to the second day. This is not doing what it's supposed to do. It's supposed to tell me, well, what is my maximum return? Come over here, stretch it out. Oh, I see what the problem is. Yeah, it's kind of a very, let's change the color here to yellow, okay? There we go, that's great. All right, I've been having this problem for weeks and I only discovered that now. Okay, so the yellow mark tells me what is the maximum gain I will have once the option expires in August the August the 11th. Okay, you can see that here. Without it, this is what it looks like. I'm already close to $1,000 in profit, and doing the rollover, maximum will be $1,500. So I'm adding about $500. Okay, sounds great. So, and my debit is 19 cents. That's because I have to pay for the extrinsic value. Meanwhile, because the option that I'm buying back, the 35, has almost $2 of intrinsic value. But then again, I have the stock. Okay, so I have some built-in stock price, and so even though I'm having a debit here of 20 cents, really I'm getting all that extrinsic value, and that's why I have an additional $500 of potential gain. Okay, so let's do that. I hope this is all clear. If not, please be sure to post your questions in the comments below. And yeah, I have to pay $60. And we'll wait. Okay, great. Filled, and it says -20. So I'm going to lock this up, and I'm going to say analyze trade, and the copy I can adjust. My new trade is August 11th, and the strike price is 37. And my value, my cost, is a little 20 cents more because it's a debit. So we are adding this number to this number, 30.46. Okay, so here we go. And you can see if I say hide, hide the position, we can see that the two trades, the original trade and the rollover, has this maximum profit of 1962, and you can see the P&L currently is $1,416. So the new trade should be about the same, should be exactly the same. Here it is, 1962, fantastic. And yeah, so I can delete the other two, and this is my current trade, calculating the profits that we have made so far, the adjustments we have made. Okay, let's move on to COIN, coin. And this is my trade here, and it looks like, there it is, okay? It has moved very much dramatically higher, but this is August the 4th. Let's look at the extrinsic value of that option, even though it's over here. there is probably a lot of extrinsic value still. So let's put, let's say 10.30. It's been moving quite dramatically. Let's simply say all strike prices, and so that we can see. That's interesting. My position is supposed to be here, but I don't see it. Oh, here it is. Okay. All right. So there's about $1 of extrinsic value. So we really don't need to do anything. We just need to see that option erode in value. You can see that my strike price is 71, but the stock is trading at 105, 106. So assume that the stock will go down. It doesn't matter because we have so much time left here, and I want this number to go to 0. So we let it be, okay? No need to change anything. All right, let's move on to the next Etsy. And in this case, July 21, that's next week, and we have plenty of extrinsic value. So look at the extrinsic value of the option. And here it is. Yeah, extrinsic value $1.16. So we can wait till next week. Okay, so very quickly, okay, here another one that is expiring today, KISS. KSS. That's calls. All right, so what do we need to do here? The option, the stock is trading at 24. Let's look at the risk graph. Yeah, this option is probably not much value left. So I think we could roll this over, but to what? Well, again, we go to the August 28th. And look for the option that has zero intrinsic value and the maximum extrinsic value. That's $1.26. I click on the bid, and I will do this 4 times. Okay. You can look at the risk graph, and if we remove everything else, this option, if it was to expire worthless, it will give us $492. Sounds great. Okay, but now we have to close this one here. Is it 0? It should be, because it expires today. The option that we're closing, you can see that 0, it means expiring today. And you can see that the extrinsic is 0. As I told you before, the extrinsic value goes to 0, so you get to keep that original extrinsic value. Of course, the intrinsic value is reflected in the price of the stock. Okay, so that goes up, goes down, it doesn't matter. Eventually, it balances out, but you get to keep, always get to keep your option extrinsic value. So let's roll it over, analyze rolling. And we're going to change the short to August 11th. And my strike price will change also, because we want the one with the most extrinsic value, so that will be the 24.5, which is closest to the current stock price. And you can see that we're actually getting a credit, which is pretty good. But again, this is already built in the adjustment to the intrinsic value. So that's why it gives us a credit of a meager credit of 21 when we are really getting 2.23 in extrinsic value. Okay, so let's hide the position, and this is what we're doing. All right, so the maximum profit will be here in this yellow area, yellow line, which will be $1,060. Okay, without the rollover, I'm stuck here at 540. So we are improving our profits by $500 a month with this trade, in theory. Okay, unless something happens and the stock collapses, but even then you will get that extrinsic value by selling your options lower and lower as the stock goes down. Eventually, when the stock rallies up, the intrinsic value of the option is compensated by the growth of the stock. So we don't care about the stock. We just assume that it will fluctuate. We're just making sure that we're making money by selling that option. Okay, so here we go. Create duplicate order. And make sure that, let's put at 32. It should feel even better. Confirm and send. Wait a minute. Okay, yeah, that's correct. Send that off. And I will adjust the new trade once it gets filled. Let's move on to MOS. July 21st, that's next week. We don't need to do anything about it. You can see that there is a lot of value there. If the magenta line is very close to the cyan line, then that means you better do a rollover because they're matching. That means that the extrinsic in the value of the option that I sold is close to 0, and we need to roll it over. Let's go to MU. August, you can see there's plenty of value there. Yeah, you can look at it this way. Move on to Roku, and that's August the 4th. Again, plenty of value there. You can tell by the chart, and the expiration is in August, so plenty of time for us to react to that. Same with SPWR, 4th of August. And this is the one that I adjusted down because the stock came down, and look, the stock is now up again. WDC, August 11th, and X, August the 4th. That's all we need to do. Let's go to the account positions, and yeah, we need to adjust this a little bit. I'm gonna lower it back to 30, and hopefully we'll get filled, but for now I'll let it sit there, and I will adjust it as needed. Okay, so we did have, I didn't pay attention, but we got this filled, and this is the position that also needs to be, let's go analyze, okay, because we have to do the same for the margin account. Okay, I'm running them in parallel. I need to show all, sorry. We got the APA field, so I'm going to say analyze trade. Here we go, and now go to the margin account, because this needs to be rolled over at 20 cents. And we'll do the same for the other trade, which is KSS, analyze trade. And let's go to margin, and we're going to do the same. Send that off. And I will be watching for the rest of the day to make sure that this gets filled before the day's up. But as you can see, up to date, when the two accounts are putting together, we have a profit of $18,000. Of course, in the IRA account, the profit is here. No, year to date. Yeah. Since the opening, we already closed a couple of trades, that's why it's different. Here is the profit. And it will be the same for the margin, except for the margin, we only have to have $50,000 in the account. But the P&L is about the same. Okay, that's all for today. Thank you very much for joining me and see you next time. Bye-bye.